Welcome to TSX Quarterly, the podcast that brings you publicly available earnings calls from companies listed on the Toronto Stock Exchange in one convenient location. Gone are the days of looking through confusing websites. You'll find the important information right here. Enjoy the call.
Good morning. My name is Chris, and I'll be your conference operator today. At this time, I'd like to welcome everyone to the Kirkland Lake Gold Third Quarter 2021 conference call and webcast. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. And if you'd like to withdraw your question, please press star 1 again. Thank you. Mark Udding, Senior Vice President of Investor Relations, you may begin.
Thanks very much, operator, and welcome everyone to our third quarter 2021 conference call and webcast. With the timing of our planned merger with Agnico Eagle, which we're very excited about, this will likely be our last conference call. And I think if you've looked at our results, you'll agree with me that we're finishing with a bang. We've got record earnings, extremely low unit costs, and a continuation of industry-leading track record over the last 5 years for returning value to shareholders. We're going to talk about all these things on today's call. With me today are most of the members of the Kirkland Lake Senior Executive Team. Speaking today will be Tony Makuch, our President and CEO, David Soares, our Chief Financial Officer, Natasha Vaz, our Chief Operating Officer, Ian Hahn, our Vice President, Australian Operations, Larry Lazetti, our Vice President, Detour Lake, and Evan Pelche, our Vice President of Mining, Kirkland Lake, as well as Eric Kallio, our Senior Vice President of Exploration. Slides accompanying today's presentation are available on our website and through the webcast. Following the presentation, we'll open up the call for questions and answers. I will draw your attention to slides 2 and 3 of the presentation, which contains our forward-looking information and other cautionary language. We will be making forward-looking statements in today's call, so I ask you to give that information due consideration. We will also be referring to non-IFRS measures during the course of the call. Reconciliations involving those measures is provided starting on page 37 of the MD&A we filed late yesterday. Finally, all dollar amounts mentioned today will be in U.S. dollars unless otherwise stated. With that, I'll turn the call over to Tony Makuch, President and CEO.
Okay, thanks, Mark, and thanks everybody for being on the call. It's not necessarily our last quarterly call because we'll just have a different name maybe when we're talking to you in future quarters. But we have had lots of success at Kirkland Lake Gold over the last few years, and definitely a very, very strong Q3. And we'll go through the results, and you can see it. Lots of outperformance in a number of areas, particularly Fosterville down in Australia, where at the end of 3 quarters already achieved full year guidance. And it continues to, and it's not just grade; it's tons and grades coming out of Fosterville, plus very high levels of safety performance and operational performance, and high attention to detail in terms of looking at social issues there. We're doing a very great job in terms of the environmental cleanup that's going on up in the Northern Territory in Australia, and a real tribute to the leadership, but all the people, the whole people that are working for us in Australia are doing an exceptionally good job, and really need to thank them for what they do. And then over in Canada, we're having a significant success in Q3, and again, Detour's going to have a very exceptional record in Q3, but we have a very exceptional Q4 as well. And again, the demonstration of strong leadership in the company, right from corporate right down through the operations, and fundamentally the people driving the trucks, the people doing the work at Macassa and at Detour are really making a big difference. And again, really thank them for what they worked on to achieve in the quarter. And And as I say, we're looking at a very strong Q4 as well as to finish off the year. Anyway, I'll start on slide 4 here, and just highlight a few things. We did have our recent announcement of an agreement to combine the merger vehicles with Agnico Eagle Mines. From our perspective, this is a very exciting development for our company, and we believe and our shareholders. And the big thing is this merger creates a new leader in the global gold mining industry. And we create a gold mining company that can definitely be a leader in terms of transforming not only transforming the industry, but also transforming and changing the perception of our industry as we move forward. Moving to slide 5, this basically gives some of the highlights of our merger with Agnico. But basically we're creating the highest quality senior gold producer with the lowest unit costs, best risk profile, leading in key areas of ESG and an extensive project pipeline to drive future growth. The combined companies have significant, very strong financial strength and an extensive pipeline of projects, and combined with a strong balance sheet, good solid operations that are performing well and profitable, we definitely see the opportunity to fund future growth internally. Merger will bring consolidation. A big thing, consolidation of the region of northeastern Ontario, northwestern Quebec, provides significant value creation opportunity through synergies. And we see some other business improvement initiatives. And I think that one of the biggest things from our perspective is the development of the new Upper Beaver and the amalgamated Kirkland properties, sort of amalgamating that into the Macassa operations in Kirkland. I think that's a significant benefit to northeastern Ontario and definitely for the shareholders of the new Agnico Eagle. And we see the new Agnico Eagle, definitely being, we got to demonstrate it, but will warrant a premium valuation. And fundamentally, what will drive that? I mean, combination of increased scale, low cost, and low risk operations. But I think fundamentally superior financial performance and continued strong balance sheet strength and good execution of operating of results will be key to driving that value, that warrant a premium valuation. And we see it as the right deal for our company and our people at the time, and as well as our shareholders, communities, and all the stakeholders and groups in the economy that we deal with. Maybe I'll move over to slide number 6 and start talking about third quarter results. Slide 6 here is really, focusing here and maybe give it a quick update on our responsible mining efforts. For us, responsible mining is integral to everything we do. It is ingrained in our culture. All of our Canadian operations participated in the first National Day of Truth and Reconciliation with learning seminars for all employees, supporting and doing things to support local Indigenous companies through orange shirt programs and painting one of our 795 trucks at Detour Lake Orange. Additionally, haul truck bids were painted green to support mental health awareness with seminars and employee training programs that are being held in both Canada and Australia. In Bendigo, Australia, we committed $600,000 to the Goldie Wellness Center and Cancer Wellness Program to assist with the sustainability of the program and expanding wellness services and improving access for regional patients. Building on our leadership in minimizing and reducing carbon emissions, we took additional steps in Q3 2021 to achieve further reductions, including testing and building an energy storage system from entirely recycled components, including the battery case and batteries from our Z40s. Turning to our financial and operating results in slide 7. As mentioned, Q3 2021 was a quarter of substantial progress. The main highlights are, Mark alluded to some at the beginning, but record quarterly earnings, solid year-over-year production growth, unit costs significantly better than full-year guidance, and strong cash flow generation. A record performance was driven by strong operating results, including quarterly production, throughput, and all-in sustaining costs at Detour Lake. Q3 was a tremendous quarter for Detour Lake production, with 189,000 ounces. That beat the previous record of 166,000 ounces in Q2 of this year by 23,000 ounces or 14%. And as I said, we're on track for a new record in Q4 this year. Fosterville also had a very strong quarter and a strong contributed to our record results. And it was a combination of great outperformance as well as higher levels of throughput to the mill. So the operation being very successful in terms of moving forward at Fosterville. And the drift, driving our achieving record production performance. also helped in terms of our unit costs. And in our unit costs in Q3 beat our full year guidance ranges. We are being impacted by the exchange rates and inflationary pressures in certain areas, but our operations are doing very, very well in managing these costs, and we're in very good shape to meet our guidance for the year. In terms of cash flow, we had operating cash flow of $323 million and free cash flow of $141 million. David Soros will give a little more color on those areas. Turning to slide 8, we continue to have a very strong balance sheet with cash at September 30th of $822 million. Again, a very clean balance sheet and no debt. We also continued on our very successful track record returning capital to shareholders. During Q3, we returned $175.3 million, $50 million through a Q2 dividend paid on July 14th, and $125.3 million through the repurchase of 3.1 million shares through our NCIB. Turning to slide 9, a significant component of our successful track record with capital allocation was investing capital for future value creation. We released encouraging exploration results at all 3 of our cornerstone assets and remain on track with our key growth projects. Eric Kelly will give a little bit more color on that, but maybe I'll just talk a few things here. The exploration, a lot of success in our exploration program at Detour. When we announced, in early September, we announced the 10.1 million ounce increase in open pit measured and indicated resources at Detour Lake. This tripled the open pit M&I resources, and it was at Detour, and we see it as was definitely a milestone in terms of being able to support strong growth in mineral reserves in the future. And that's going to come out next year as we complete our studies this year. And then earlier this week, we announced additional new drill results. And, I think these continue to highlight the fact that, the 10 million ounce increase in resources is not the end of it all. We still see the potential to continue to grow the resource at Detour before the end of this year, and then it really supports what we give in terms of our view, and the view we put out of Detour when we acquired it back and when we made the acquisition announcement back in 2019. Besides the exploration success at Detour, we are making very good progress with a lot of other projects at the mine in terms of value creation and optimizing the operation, and that includes increasing the throughput in the mill. Actually, the mill in July and August of Q3 actually was running at a rate that almost 28 million tons per year. We had significant improvements in grade management at Detour, and we have a lot of other infrastructure that we're installing at Detour that really help in terms of build the operation for the long term and really support future improvements both in operating performance, but also in safety and care and consideration for people and for the site. At Macassa, the number 4 shaft remains ahead of schedule, on track for completion later this year. We also had, completion of the sinking later this year. The actual installation of loading pockets and getting that ore handling system and the changeover from a sinking plant to a production plant will be started, and we expect this shaft to come into full production or be ready for production in Q4, into Q3, in Q4 of 2022. We also had significant exploration success at Macassa, expanding the South Mine complex and identifying new areas of high-grade mineralization on both the amalgamated and main breaks. And looking at Fosterville, we did come up with some very new and interesting exploration results. They were released at the end of August, and I guess what it tells you is there's potential for continued discovery of new high-grade intercepts, and our goal at Fosterville is to demonstrate an operation of 300 to 425,000 ounces a year on an annual basis for 7 to 10 years in production. I think we got lots of work to do, but we definitely feel confident that we'll be able to achieve that and demonstrate that to shareholders. Now moving on to slide 10, let's look at our year-to-date results. We had a solid year-to-date operating versus our full-year guidance. Production with just under 1.1 million ounces, a 5% increase from year-to-date 2020. We achieved a very solid unit cost performance, record earnings, and strong cash flow generation. You can also see that on the slide that so far this year we have repurchased 4.5 million shares for close to $184 million. We returned about $334 million to shareholders, which represents $1.28 per share and $317 per ounce produced in year-to-date 2021. Now on slide 11, let's look a bit closer at a track record of returning capital to shareholders. We have now returned a total of $1.36 billion to shareholders since we first introduced our NCIB in May 2017 and our dividend policy in March 2017. Of this amount, just over $1 billion was used to repurchase 31.5 million common shares, and $315 million was used to make 17 quarterly dividend payments. Those dividend payments have increased 7 times since we began issuing them in 2017. In addition, since mid-2016, we have eliminated over $190 million of debt. This includes paying $98 million of debt held by Detour Gold Corporation shortly after it was acquired in January 31, 2020. $30 million was also used to close out Detour's gold hedge position. We earned a very good return on that $30 million given the changes in gold and commodity prices and FX rates that followed in 2020 and in 2021. We also repurchased a 1% NSR at McCaslin from Franklin, Nevada in 2016 for almost $36 million. Adding it all up in aggregate, we have provided $1.6 billion of value to shareholders since mid-2016, and we've done all this while also building the industry's strongest and cleanest balance sheets. Looking at slide 12, it shows our performance against guidance. As you can see, we are very well positioned to achieve our guidance entering the last quarter of the year. We are targeting the top end of our production guidance and on track to achieve our operating cash cost per ounce guidance. We are doing very well in terms of all-in sustaining cost per ounce sold at $785. Our year-to-date all-in sustaining cost is better than our guidance. We definitely expect to meet and potentially beat our all-in sustaining cost guidance for the year, and that's in spite of inflationary pressures related to diesel fuel and power energy costs. And the change in the FX rates would have an impact. Looking at our expenditures, if you take sustaining and growth capital expenditures together, total CapEx guidance is $530 to $585 million for the year, and we are tracking to be in line with that range. Also, exploration spending should be in the low end of our guidance of $170 to $190 million for the year, and that's the lower end of achieving the exploration guidance is mainly a function of lack of, we can get access to drills, we can get access to a lot of equipment to do the work, but we can't get people to man the drills, and that's been a challenge, and I think a challenge for our industry going into 2022. Anyway, with that, I'll turn the call over to David Soares, our CFO.
Thank you, Tony, and good morning, everyone. I'll start on slide 13. In Q3 2021, we achieved record net earnings of $254.9 million, or 96 cents per share. This represented a 26% increase from $202 million in Q3 2020 and 4% increase from $244.2 million from the previous quarter. The increase from both prior quarter and prior year resulted mainly from higher revenues. Adjusted net earnings totaled $241.3 million, or 91 cents per share. The main difference between adjusted net earnings per share of 91 cents and net earnings per share of 96 cents in Q3 2021 was mainly related to the exclusion of $15.6 million net tax recoveries resulting from the optimization of discretionary deductions for Ontario mining tax on filing the 2020 tax returns. Foreign exchange gains, costs attributed to non-operating assets, mainly in Northern Territory, system implementation costs, as well as COVID-19 related costs. Turning to slide 14, in Q3 2021, revenue totaled $667 million. The change from Q2 2021 is mainly driven by an 8,000 ounce increase in sales volume, which is partially offset by lower realized gold price in the quarter. Compared with Q3 2020, revenue increased by $34 million, or 5% year over year, mainly due to a higher gold sales volume, which increased from 332,000 ounces in Q3 2020 to 372,100 ounces in Q3 2021, with the increase largely reflecting record gold production at Detour Lake and strong production at Fosterville, partly offset by unfavorable impacts from the lower average gold price. Moving to the next slide and looking at EBITDA on slide 15. Q3 2021 EBITDA totaled $451.6 million, which was comparable to Q2 EBITDA of $451.3 million. Compared with the same period in 2020, EBITDA increased by $67 million, mainly as a result of higher revenues. Looking at income taxes, our Q3 2021 net earnings benefited from a lower effective tax rate of 25.3% versus 31.6% in Q3 2020, mainly as a result of the $15.6 million net tax recovery related to the optimization of the eligible tax deductions for Ontario mining tax following a restructuring of the company's Canadian entities early in 2021. Moving on to slide 16, we look at the Q3 cash flows. You can see that the largest contributor to growth in cash was from our operations, which generated about $396 million of cash. This is before income tax paid of $78 million, growth capital investment of $88.5 million, and exploration spending of $39.4 million in the quarter. Other cash outflows include the costs incurred at our non-operating sites, mainly the NTN Hope complex of $15 million and corporate G&A of $14.3 million. During the quarter, $175.3 million was returned to shareholders, including $125.3 million used to repurchase shares through the company's NCIB and $50 million of dividend payments. Turning to slide 17 to look at our cash balance and cash flow on a year-to-date basis, we generated nearly $1.1 billion of cash flows from our mining operations after sustaining capital. We paid $298 million of income taxes. We invested in our key assets, incurring $217 million in growth capital and $128 million in exploration expenditures. We would have accumulated ending cash balance of nearly $1.2 billion before returning $334 million of capital to shareholders, comprising of $184 million used to repurchase shares and $150 in dividends paid on a year-to-date basis, ending the quarter with $822.4 million in cash. Next, I'll turn it over to our COO, Natasha Vaz, to discuss our operating results.
Thank you, David, and good morning, everyone. I'm on slide 18, which outlines our consolidated production results for the quarter and year-to-date. So overall, as Tony mentioned earlier, we achieved solid operating results in the quarter with production just over 370,000 ounces compared to 339,584 ounces in Q3 2020 and a quarterly record production of 379,195 ounces the previous quarter. Our operating cash cost per ounce sold was $438 an ounce, which is well below our full year guidance. And then as for our AISC per ounce sold, it was also very strong at $740 an ounce. This is a 16% improvement from Q3 2020 and 5% better than the previous quarter. The $740 an ounce also compares very favorably to our full year guidance range of $790 to $810 an ounce. So then when we look at our year-to-date operating results, they too are very strong. Year-to-date production totaled 1.05 million ounces, which is a 5% increase from year-to-date 2020. Our operating cash cost per ounce sold was $466 an ounce compared to $407 in year-to-date 2020. And finally, our AISC per ounce sold was $785 an ounce versus $804 in year-to-date 2020. So with that, we'll now get into a little more detail on the operations. And I'll turn the call over to Ian Hahn, our Vice President of Australian Operations, to provide an update on Fosterville.
Thanks, Natasha. I'll start with Fosterville on slide 19. As you have heard, Fosterville had a very strong Q3. Fosterville produced 135,000 ounces in Q3 2021, based on processing just over 180,000 tonnes at an average grade of 23.6 grams a tonne and average mill recoveries of 98.7%. Production in Q3 2021 exceeded expected levels, mainly due to continued grade outperformance in the Swan Zone. For the year to date, we produced 401.4 thousand ounces, significantly higher than target levels, largely reflecting grade outperformance in the multiple Swan zone stopes during year to date, as well as some changes to sequencing involving moving high-grade stopes from Q4 into Q2 earlier in the year. Production year to date 2021 compared to production of 476,000 ounces for year to date 2020. The reduction reflecting a lower average grade consistent with our previously stated plan to reduce production with the intention of creating a more sustainable operation while we continue our extensive exploration programs. Partially offsetting the impact of a planned reduction in the average grade was a 28% increase in tonnes processed to just under 525,000 tonnes year to date 2021. Turning to costs, again we achieved a very strong performance for both Q3 and year to date. For Q3, we had operating cash costs of $170 an ounce and all-in sustaining costs of $337 an ounce. For the year to date, operating cash costs averaged $184 an ounce, with all-in sustaining costs of $367 an ounce. I'll now turn the call over to Larry Lazecki, General Manager and Vice President of Detour Lake Mine.
Thanks, Ian. We'll start on slide 20. As Tony mentioned earlier, quarter 3 was an outstanding quarter for Detour Lake. We achieved record quarterly production in Q3 of 189,000 ounces based on processing 6.2 million tons at an average grade of 1.04 grams per ton and average recoveries of 91.6%. This is an increase of 35% from Q3 2020 and an increase of 14% from the previous quarterly record of 166,000 ounces in Q2. The quarter-over-quarter increase was largely due to a 5% increase in tons processed as well as an 8% improvement in the average grade. Mining during the quarter focused largely on high-grade areas as part of the Phase 2 mining plan. For year-to-date 2021, we produced 501.8 thousand ounces, which is 38% higher than the 8 months after the acquisition last year, and a 22% increase from the full 9 months of year-to-date 2020. Looking at our operating cash costs, averaged $601 in Q3 and $647 per ounce for the year-to-date. Very importantly, the mine achieved record all-in sustaining costs of $937 per ounce sold. Our strong cost performance was achieved despite some inflationary pressures we've seen on diesel, fuel, and energy, and in a few other areas. We continue to work on mitigating the impact of those cost pressures.
Hello, Discover here to explain our cash back match. Here's how it works. We give you cash back for using your Discover card on the things you were going to buy anyway. Then we match that cash back in your first year. And that's why we call it Cashback Match. Now to recap and say cashback one more time. We match all the cash back you've earned at the end of your first year automatically. Discover. Exceptionally common sense. Learn more at discover.com/match. Limitations apply.
The stockings are hung and the shopping has begun. This holiday season, shop Cincinnati favorite gift cards at Kroger. Grab a gift card to La Rosa's and enjoy a warm slice of pizza. Or snag a gift card to Grater's and treat yourself to something sweet. Whoever you're shopping for, you'll earn 4 times fuel points on Cincinnati favorite gift cards. Head over to giftcards.kroger.com/Cincinnati-favorites to complete your shopping list and support our local businesses. Available in Cincinnati, Columbus, and Louisville markets only. Restrictions apply. See website for details.
Moving to slide 21. As Tony mentioned earlier, we have a significant number of projects on the go at Detour Lake. Our growth capital expenditures at Detour for the first 9 months of the year totaled $137 million. Of that amount, $66 million was for deferred stripping, and $70 million was for the procurement of mobile equipment and projects involving tailings management area, process plant, as well as construction of a new assay lab and airfield. With that, I'll turn the call over to Evan Pelche, Vice President, Mining, Kirkland Lake.
Thanks, Larry. I'm starting on slide 22. Production at Macassa in Q3 totaled 46,000 ounces at an operating cash cost of $657 and an all-in sustaining cost of $859. The increase in production from Q3 2020 mainly reflected a higher average grade in Q3 2021 compared to the same period a year earlier. The reduction in production from Q2 2021 reflected lower tons processed due to largely to higher levels of underground maintenance and reduced equipment availability, as well as the impact of the lower than planned average grade due mainly to mining sequencing. Looking at year-to-date, production at Macassa totaled 148,854 ounces based on processing 243,615 tons and at an average grade of 19.4 grams per ton and average recoveries of 98%. Production year-to-date is lower than planned, with the underperformance being due largely to reduced equipment availability caused by increased maintenance requirements, poor battery performance, and delay in receiving new batteries. Moving to slide 23, where we are doing very well at Macassa is advancing our key projects, mainly the 4 shaft, as well as with exploration, which I know Eric talked about in last quarter's call. Looking at 4 shaft during Q3 2021, the shaft advanced approximately 500 feet and had reached a depth of 6,100 feet as of September 30th, 2021, with development of the 6,100 level station also being completed. We also have made good progress with other projects, such as our ventilation expansion involving completing of the 2 vent raises. With that, I'll turn the call back to Natasha Vaz.
Thanks, Evan. So to wrap up the operating review, I'll look at the outlook for the full year. I'm on slide 24. On a consolidated basis, Tony has already touched on it, and as he mentioned, we are on track to achieve the top of our production guidance of 1.3 to 1.4 million ounces. Operating cash cost per ounce is on track to achieve guidance, and we are positioned to either meet or potentially even beat our all-in sustaining cost per ounce guidance. Okay, so just looking at the individual operations, Fosterville achieved its full-year guidance in the first 9 months of the year. So we're now expecting Fosterville to produce around 500,000 ounces for the year or higher. Also, with respect to operating cash cost per ounce, we should easily beat the guidance range of $230 to $250 an ounce. Over at Detour, we're targeting another record quarter in Q4 with production to exceed the Q3 level of 189,000 ounces. So we now expect production for the year of at least 700,000 ounces with operating cash costs at the top end of our guidance range or slightly higher. And then over at Macassa, we are already seeing improved results in Q4. Having said that, we're not expected to achieve our guidance with production now planned to be within 190 and 210,000 ounces at operating cash costs above the guidance range. With that, I'll turn the call over to Eric Kallio, our Senior Vice President of Exploration.
Okay, thanks, Natasha. Good morning, everyone. My first slide today is number 25 from Detour Lake Project, where we continue to have tremendous success with both drilling and advancement of the resource, with the key product being an updated resource and a substantial increase in ounces from our latest year-end. Here information from the estimates shown on the current slide, which is a long section looking northwards across the project area, containing pit shells from both the new and the older work. As indicated, the updated resource is added approximately 10.1 million ounces to the overall total, and bringing the new total to about 14.7 million ounces, exclusive of reserves, which at year-end were about 15 million. All this material lies in a pit shell, which is measuring about 4 kilometers long and extending to about a maximum depth of 600 meters from surface, with all reserves located at the top, shaded in the dark green, and all the resources lying below is shaded in yellow and lighter green, which is essentially covering the whole Battle and Westwood areas, the main focus of our recent drilling. Important to note that all this increase was accomplished with only about 180,000 meters of drilling, or 2/3 of the planned 270,000 meter program started last year. And the limits of the pit are really close to the limits of drilling, and we are still seeing good holes at those limits. So now turning to my next slide, number 26, what we see here is another image from Detour illustrating additional details from the resource model, along with new drill results released just 2 days ago and already demonstrating additional upside potential here. As announced, the new results include an additional 39 holes and 6 wedge holes targeting mainly towards the west pit, and in our view, containing a lot of very good positive messages, including reinforcement of our overall geological model of westward plunging chutes with some very positive drill intercepts. Some of the key holes to note from the drilling include a cluster, from my view, would be cluster holes on the west side of the current pit shell, where there was very limited drilling in the past, and now containing some wider and higher grade intercepts, as well as hole number 300, which you see more in the central part of the west pit, which is actually drilled under the north wall of the pit, and also having good intercepts. The other good hole I'd like to point out is number hole 295, located in the eastern part of the saddle, which intersected 20 grams over 25 meters, so just in the immediate west wall of the main pit. So considering all above and the fact that we still have 11-12 drills on site, continuing the program, and we actually are feeling very confident about the project and our possibilities to add even more ounces by the time we do the next update. Now turning to my next slide, which is number 27, we see the first of four slides relating to Fosterville, and where we also saw some very good success in Q3, including multiple high-grade intercepts for both the Lower Phoenix and Robbins Hill areas. In terms of the slide at hand, what we see is a long section across the mine area that's showing the location of these two main targets, as well as some details for our 21 exploration program. Indicated the Lower Phoenix is on the left-hand slide, has two main targets, including the Swan and Signet, and most of the work at this time being focused on the Swan and down plunge extension of mineralization from current reserves. Work at Signet. The Signet is the second zone located 100 meters in the footwall, and is also an important target here. Important to note is that until the early part of this year, most of the work at Swan was not really available to us, but only became more available when a new drift was finished in June, and now we have 5 drills at this location and able to do a lot of drilling in this area. Additional to this, we also now have a lot of drilling happening at Robbins Hill, and as with the Swan area, the main target is down plunge from the reserve. Most of the work to date has been done from surface, but as you can see, we are still continuing to advance the underground decline and getting very close to be able to start drilling from underground. Turn to my next slide. What we can see is some additional details for the work that's happening at the Swan zone, the Lower Phoenix area. And key things to note here would be we're starting to get a large number of holes. 109 holes were actually released in the last press release here. All these holes are showing a fairly consistent trend down plunge from the reserve. We're also seeing some very high-grade intercepts right near the limit of the reserve, including 51.7 grams over 2.6 meters, 12.8 over 4.6, 9.6 over 6.4. So, and in addition to that, what we've seen is higher grade intercepts within the trend, 14.1 over 7.5, 10 over 10.4, 13.2 over 3.2. So in our view, offering additional potential for high grade lenses within the overall trend. So turning to my next slide. This is just showing a little bit more detail for the drilling which is happening in the Signet area. And as indicated, as with the Swan drilling, we've got quite a few new holes located within this area now. And from the new drilling, seeing a lot of new high-grade intercepts. Some of the key ones being 258 grams over 1.8, 142 over 2 meters, and 494.4.1. Key part of this drilling, though, has been not only the higher grade results, but identification, I think, of parallel splays coming from the main structure, which we identified in the past, with the key ones being the pen and the targeting. And these are defined, these are shown on the left-hand side of the slide. And as you can see, these are more directly aligned with the Swan and containing some of the higher grade intercepts. So very important developments, I think. Turn to my next slide, which is from the Robbins Hill area. As you can see here, we're also starting to get quite a few drill intercepts, and now holes extending down to about 1,000 meters down plunge. And as announced in our last press release, seeing some very favorable results right near the limiters of the trend, near the 1,000 meter level, very close to the elevation where Swan started to look better. We're seeing holes that have quartz visible gold and numbers which are much higher grade than the average that we saw at higher elevations, including 28 grams over 1.1, 23 over 1.4, 13, and 19 over 3.4. As with Swan, we also see some very high grade numbers within the trend, such as 81 grams over 2.5 meters, which again suggests the possibility of high grade lenses. So all in all, we believe that the work at Fosterville coming along very well, and a lot of possibilities for not only replacing ounces, but coming up with new high grade material. And now I'll pass it over to Tony.
Okay, thanks, Eric. And I'm turning now to slide 31. I'll find the slide in our deck. To conclude, as you can see, we had an excellent quarter in Q3 2021. We talked besides operating results, we also had a highlight in the quarter in terms of the merger announcement with Agnico Eagle, which will create a new leader in the gold mining industry. And again, as we talked about, the lowest cost, highest margin, best jurisdictions, and an extensive pipeline of development and exploration projects to drive sustainable low-risk growth. And, with a very, very strong balance sheet and strong core group of depth of people to create that value for shareholders. Q3 was a record quarter in both earnings and earnings per share for Kirkland Gold. And as outlined, Detour Lake had a truly outstanding quarter, record earnings, throughput, and all-in sustaining costs. Fosterville continued outperformance. It continued to outperform. And the shaft number 4 project at Macassa remains on track for completion in late 2022. And that'll really help in terms of that. And combined with that, plus the new ventilation system at Macassa, plus the new fleet of equipment as we move into 2023 will really transform Macassa into a whole new mine. Eric outlined our success. It's a drill bit that continues to be part of all of our value creation. And you can see he's doing that in each one of our assets, each one of our mines. And looking ahead, as Natasha gave some color to, we're on track to finish 2021 strong and achieve all of our 2021 guidance. We're also looking forward to moving into 2022 as part of a new world-leading great gold mining company, and it's one that's well positioned to generate superior long-term value for shareholders. But before I finish, I want to say it's November 4th, and we're as we talked about, we are having a strong production success coming into Q4, but we're also at the start of the Christmas season. During a period of time, maybe to ask everyone within Kirkland Gold, our suppliers, contractors, those on the call, please remain diligent for your own personal safety and the safety of others as we end the year. We don't really want anybody to get hurt. No ounce of gold produced, no dollar in cash flow, no penny in earnings is more important than your personal safety and the personal safety of the people you work with. Everybody should end the year here being able to be with your families over the Christmas season. Anyway, with that, we have to take some questions, and thanks.
As a reminder, if you'd like to ask a question, please press star then 1 on your telephone keypad. And our first question is from Tyler Langdon with JP Morgan. Your line is open.
Good morning. Thanks for taking my questions. Maybe just to start, can you talk about the sort of the levels of cost inflation that you're seeing right now, and sort of what you're seeing in areas for materials and labor and fuel, and then just kind of talk a little bit about your expectations heading into 2022.
So the first part, I just sort of missed a little bit of the first part of the question, but it was you're asking about what we're seeing in terms of labor inflation as well. Is that correct?
Yeah, just the cost inflation you're seeing now, and just from whether it's from materials, consumables, labor, fuel, just kind of sort of the different buckets.
Yeah, well, I mean, we don't see anything undue in labor. I mean, labor is, follows tracks that we normally see year over year in terms of net labor cost. But again, part of it all is as we train and develop people, as people earn more, they become more productive and create more value. So a lot of that gets offset. So people earn the pay that they get, the increases in pay, it's always money well spent in those areas. We're happy to do it. In terms of commodity prices, I mean, I think some of the big areas, and we can get to Tasha and Ian and Larry to give a little more color, but some of the big areas as we talked about is, our forecast where diesel was at the beginning of the year to where diesel prices have gone, some energy price and costs, where we see that, and a few other commodities. Definitely the FX rates have had some impact on us, but as you can see, our operations have been able to really weather that and perform well. And probably we would have had, if commodity prices would have stayed the same, we probably would have been at a significant beat in our cost guidance. But Natasha, you got any color there?
Yeah, basically, hi Tyler, in Q3 2021, we have seen some inflationary cost pressures, as Tony mentioned, mainly in diesel and electricity and things like grinding media. It has mainly impacted us at Detour. There have been some supply chain issues, as Evan mentioned, particularly with batteries and battery-powered equipment. But, through effective cost management and higher than planned gold sales, largely at Fosterville, our operating cash cost per ounce and also our AISC sold in Q3 2021 were significantly better than the full year 2021 guidance ranges, right? And then, so looking forward into 2022, we expect inflationary pressures for energy and consumables to continue. And while difficult to predict, I guess, we can safely say that we're focusing on working to mitigate that and focusing on cost management as we go through.
Great. And then just as a final question at Macassa, you mentioned some of the issues that impacted production in Q3, and you said you're seeing improvement now in Q4. I mean, should these issues largely be resolved in Q4, or could they sort of slip into Q1 of next year?
Sure. Well, yeah. So the underperformance we've seen at Macassa is again mainly related to equipment availability caused by increased maintenance requirements and also poor battery performance and delays in receiving the new batteries. So the battery truck industry is relatively new, as you know, and with demand soaring, we are seeing tightness in the market as well as some issues with quality. So the battery life we're getting at our mobile equipment is down in some cases to 6 months instead of years. We are seeing some better results in Q4 so far, so it is encouraging. We are working with our suppliers hand in hand to try and resolve these issues as soon as possible so it doesn't impact us as much going into future quarters.
Yeah, if we went back a few years ago, Macassa was a leader in battery technology, battery equipment. I saw it underground. We were really the only consumer of batteries, and so we were getting the quality and timely delivery and effectiveness of them. But now, as the industry's picking up and more of the industry is asking for this equipment, the supply industry is not able to match, and all of a sudden now that you're seeing a drop in quality as well as the timeliness of delivery and even availability is exceeded. We need to wait for the supply industry to catch up, and we're working on a number of initiatives to support that.
Great, that's it for me. Thanks.
Our next question is from Ovais Habib with Scotiabank. Your line is open.
Thanks, operator. Hi, Tony and Kirkland Lake team, and congrats on a strong quarter. Really thanks for taking my questions. Couple of questions for me, and I apologize in advance if you've already touched upon these. Several companies have reported updates this morning, and I'm trying to multitask as best as I can. So my first question is regards to Fosterville. Now, obviously, Fosterville's had a fantastic year, Q3 production beat as Fosterville kind of continues to on the grade outperformance. You have made changes to the mine sequencing, essentially bringing higher grade forward, but at the same time, you seem to be getting some significant positive grade reconciliation as well. Are you expecting this to continue into 2022, and are you modeling this positive grade reconciliation in Q4?
How about Ian? You probably could have a real good answer to this question. Is that fair?
Yeah, sure, Tony. It's a good question. So the grade outperformance so far we've seen this year has really only come from three stopes mainly, and those three stopes account for essentially about 60,000 ounces of the overperformance so far this year. So we don't see the broad range of stopes in Swan are modelled really well and reconcile really well. We do have the odd really extreme grade areas that are really difficult to model, to be honest, and it takes very small variation in physical size of vein to add significant ounces into the equation for the stope. So do we see it continuing? We have seen a little bit of outperformance already in Q4, but having said that, over the year we're really only talking about three main stopes. As for the sequencing changes, driven by mine sequencing at the start of the year, so these decisions were made in Q1 leading into Q2. It had the effect of dragging some higher grade stopes from Q4 into Q2 as compared to the original plan. But really the main contributor for the year has been those sort of three stopes that outperformed significantly. Does that answer the question?
Yes, it does. And just to kind of follow up on that, are you looking to kind of tighten up drilling or do some additional grade control drilling to kind of tighten up that model, or is this positive reconciliation, you're just taking it as it comes?
Look, good question. The drilling that we'd need to be able to really pinpoint what are really very small physical changes in vein width and or gradation. We'd be talking about 5x5 sort of drilling. So we don't intend to do that. And we understand the geological setting where these types of really extreme outperformances can occur, and we'll be looking to try and model that as best we can going forward. But I'll reiterate the vast majority of the Swan reconciles really well to model. It's just the odd stope where we tend to have a bit of a football splay to it that's significant. We understand the geological setting where these types of really extreme outperformances can occur, and we'll be looking to try and model that as best we can going forward. But I'll reiterate the vast majority of the Swan reconciles really well to model. It's just the odd stope where we tend to have a bit of a football splay to it that significantly outperforms.
With that though, you still are expecting a pretty solid 2022 coming into it, right? Certainly, Tony. Yep. We see 2022 still being a very strong year for Fosterville.
Perfect. That's great, Ian. And just shifting gears to Detour, it was great to see throughput moving higher in Q3 to 67,000 tons per day, and really to meet the target of that 24.5 million tons for the year, you need to kind of process around that 70 to 73,000 tons per day in Q4. Now, do you need any additional equipment or any additional to the plan to achieve this, or are you on track? Any color you can provide in how October is progressing?
You can answer that question, right, or Natasha?
Sure. I can start and then Larry can finish. But overall we're in pretty good shape. In Q4 from a mine perspective, we have good material and we're on target to have some good blast in the quarter. The mill is shaping up to be very good. We have a small shutdown planned in the quarter, but nothing material. So from a plant perspective and from a mine perspective, we're in good shape to hit our target. Larry, you want to add some more color?
Yeah, sure. In fact, it's we're very optimistic that we're going to finish strong in Q4. We've already got a good start in October. As we mine through some higher grade zones in phase 2, that's going to continue not just this quarter but into next year. So from the mining end, we're in pretty good shape. And actually, as we haven't even seen the benefits of the growth projects at the front end of the mill yet. So things are looking pretty strong to finish the year. So the team has worked really hard to make some operational improvements. So the increase in throughput is actually not through our growth projects yet. As they come online this quarter and into next year, should only help us and de-risk our tonnage. So thanks.
Yeah, a lot of the success from a throughput point of view, it's a lot of initiatives. There's a lot of small initiatives. It's like a lot of the big projects are still to come in 2022, right? So.
Perfect. That's a great update. And just to confirm, in terms of the grade, I mean, grade moved up over a gram per ton in Q3, and is that expected to remain around the gram per ton going into Q4 as well?
Go ahead, Larry.
Yeah, absolutely. And again, phase two, we're kind of right in the heart of the ore body right now, going through the underground areas, and we expect to be in and around a gram a ton, maybe a little better.
Perfect. And that's great, and I really appreciate the color. And that's it for me. Thank you.
Our next question is from John Tumazos with John Tumazos Independent Research. Your line is open.
Thank you. I know you provided some explanation. I wanted to give you a chance to explain a little more. The tremendous 67,368 tons a day through the mill at Detour. I'm assuming that it wasn't softer rock, and that part of it was a significant increase in uptime due to better maintenance practices and infrastructure improvements, and that some of it was due to specific, relatively small capital improvements that don't stand out on the cash flow statement, but obviously had a big impact. Please tell us how you did such a great job.
How about Natasha?
Yeah, I'll let Larry speak to the details as well. But hi, John. So there are some initiatives that we've been working on with respect to drill blast and getting higher fragmentation. We did see some opportunity where we recovered some more within the areas of the talc area, so it is better material. There's some work being done on the mill side with respect to choke feeding and filling that up. Larry, do you want to add any more details associated with that?
Yeah, sure. I think Natasha, you nailed most of it there. It's really focused around optimizing our high-intensity feed, high-intensity blasted fed. So we are producing more fines, and yes, it is just as hard as it ever has been. But so you got that, the choke feeding, and really just the team working together between the mine and the mill and making sure that the feed is consistent. And actually, on the uptime, we did have two plant shutdowns in Q3 with only one in Q4. So
uptime was not a factor. You actually had more downtime.
Yeah, that's correct.
Well, congratulations.
Our next question is from Mark Parkin with National Bank Financial. Your line is open.
Thanks, guys. Congrats on the good quarter. It's certainly been the focus of the call. But on Detour, can you just give us an idea of like where you're seeing, what's the bottleneck, currently? Is it more, the mine is hungrier, or, it's more on the mining side? Is it mine or mill that you're kind of focused on near term in terms of unlocking the next step of throughput upside?
Go ahead, Natasha.
Sure. So I think the mine is producing in a pretty good rate. The mill is doing, the front end is doing very well. I would say if we wanted to increase throughput going forward into the future, even further, I would say it would be the back end in terms of the CIP circuit and the bottlenecking that, and that's part of the projects that Larry and his team are working on. to get established and commissioned later next year. Larry, any more color on that?
No, that's good. That's where our focus will be in the first half of next year for sure, is in the back end of the plant.
Yeah, but in terms of mine throughput, I mean, and if you look at the updated mine plan that Andre Letty group put up, I mean, as we progress into next few years, we increase mine throughput, mine output. We're going to be adding trucks to support adding trucks. We're going to, we need shops and things on site. So there's that. We're looking at in new infrastructure in terms of putting a private LTE network, a partnership with Rogers Communications to do that. And then take advantage of technology on site. So a lot of those initiatives that'll help in terms of increasing throughput. Plus, as we go into the larger pit concept, it gives you more geography to work with and a lot more flexibility in terms of less delays in terms of equipment moving around, et cetera. So there's a lot of these things that are going to come. And as Natasha and Larry mentioned, in terms of the plant, we're working on the front end to improve throughput through the crushers into the SAG mill, and that's part of that is the screens and the refeed system. And then getting more tons to the mill is good, but if we don't, not at the expense of recovery, and that's where, as Natasha mentioned, we're working on improvements in our expansion of our leach circuit, our CIP circuit, as well as the new gravity circuit, additional gravity circuit being added to the mill over the next while.
All right, thanks for those details. Two other things is, historically, we saw loading rates in terms of what a truck could actually be loaded to versus what it was actually being loaded to. That was kind of a historical issue pre your management time. How has that kind of shifted to where you're kind of operating today? Are the trucks kind of right in line with maximum capacity? And then historically also there was a fair bit of rehandle. Now that the open pit continues to mature, are you seeing relative to historical years the amount of rehandle fall, or is that still kind of something that the west pit really unlocks the potential of showing significant improvement on that front?
Hi, Mark.
I can
Go ahead, Larry. Sure.
Okay, sorry. I can speak to the truck payloads. It's something actually that's been ongoing for a couple of years now. Is we've looked at the bodies that we had originally with the 795s and looked at the kind of right weighting the trays and to get a bit of the increased payload. So we've always been focused on maximizing GVW and keeping within a fairly tight range. But with these, as we continue to add the truck bodies, we've increased payload by almost 2.5% here over the last maybe 4 quarters or so. So that probably gives you a bit of and we ask our shop operators. It's something we monitor very closely and ask them to make sure that we're paying close attention to maximizing payloads as well. So.
Okay, excellent. And just on the rehandle?
Oh, sorry. Yeah. Within the pit, there's very little rehandle. We really focus on establishing a good haulage and ramp system right off the bat. However, we do still have kind of historic levels of rehandle with ore up on the ROM, and that's actually been fairly important for us to achieve these levels of mill throughput. So when we focus on our high intensity blasting in the ore zones, we can't do it everywhere. It's only in the areas that are kind of safe with respect to minimizing dilution. So we have to stockpile a fair bit of ore so that we can maintain a consistent blend going through the mill.
And is that something that if you have West Pit opened up, you can kind of balance it off by doing ore in one while waste in the other? Or is that not how you guys see it? It'll still be something to like what you're kind of running at now?
Yeah, we foresee rehandle levels to be kind of in line with where we are currently.
Okay. All right. That's it for me, guys. Thanks very much, and congrats again.
Our next question is from Vaha Turek with Credit Suisse. Your line is open.
Hi, good morning. Thanks for taking my question. I'm just trying to get a sense of what will be incorporated into the next year's life of mine plan at Detour. So it sounds like, obviously the year-end reserves will be part of that. Earlier in this call, there was something mentioned about potentially debottlenecking the back of the plant. Are those efforts or that optimization, is that going to be factored into the plan as well, or is that just potential further upside?
Well, in terms of the, all the effort we talk about debottlenecking the plant, that this is all part of the what's going into the mine plan, which is being used to drive value. There's a lot of those initiatives I alluded to it. Once we, you got to be increasing the size of the truck fleet, and increasing maintenance capabilities. A lot of other initiatives in terms of sort of saying and grade control improvements that we're working on. Natasha mentioned about blasting improvements. That's been an initiative for quite some time at Detour. But, Natasha, maybe you give more.
So everything we see tells us that we're headed for a strong growth in mineral reserves, and that we're well on the road to transforming Detour into one of the largest and most profitable gold mines. But in terms of what next year's reserve increase will look like, the new mine plan will look like, yes, we'll factor in all the improvements that we're working on. What Tony mentioned, the CIP debottlenecking was part of this past life of mine update as well. So that will all get factored in to get that mill running at the higher throughputs that we anticipate. But there's still a lot of work to do from a life of mine perspective, and we'll get through that in early next year.
But in the CIP plant, if we could go back, we would have built a different style CIP plant than what's there. But we live with what we got, and we, as people, the people at the site have done a great job in terms of identifying the areas that can be done for improving it and removing any bottlenecks there. So.
Okay, got it. So it sounds like all of that is being factored in. Okay. And then just switching gears to Fosterville just quickly, you already spoke about grades, but just on throughput, obviously throughput this quarter was quite strong. I'm just trying to figure out for Q4, because even if I keep throughput even flat or slightly down, you're going to be well ahead of even above 500,000 ounces for the year. So is that throughput level sustainable into Q4?
Go ahead, Natasha.
Hi there. There's with Fosterville, we're expecting to see some pretty decent throughput levels. We do have a shutdown coming up, but overall, I believe that we're projecting the grades in some of these areas that we're mining to be somewhat lower. Ian, do you want to provide any more color on that?
Yeah, sure, Natasha. Look, the mine's really well sequenced at the moment. With the guys are on top of the development, and that flows through the stoping. I think what we've seen so far is that with the impact of paste fill coming on, last year and then really embedded this year, and a lot of the work on site that's gone into the production sequences themselves. We're seeing the benefit of that now with the increased productivity of our stoping. And we expect that to continue on, and in fact, we would see ourselves improving our tonnage productivity over the coming years.
And I guess the other part in terms of the plant itself, you still have not achieved. The plant is up to 850,000 ton a year or plus plant, right? So it's not milk that's holding it back. It's mine productivity, right? And that's maybe a function.
That's right. Got it. Okay, that's it for me. Thank you.
We have no further questions at this time. I'll turn the call back over to Mr. Utting for any closing remarks.
Well, thanks everyone again for taking part in our call today. As you heard, we had a very strong third quarter and a very strong first 9 months of 2021. And even more important, we're positioned for a very strong finish and to finish the year very well relative to our guidance. Looking further ahead, as I said when I started, we're very excited about the upcoming merger with Agnico Eagle, and we're looking forward to entering 2022 as really a new leader in the gold mining industry. Thanks very much.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now.
Hello, this is Discover, and we take customer service very seriously. We know that if you have a question or concern about your credit card, that's a serious matter, and you need to talk to a real person about it. So we offer around-the-clock access to seriously talented representatives in the USA. Again, it's a serious endeavor. The only funny thing about it is Bob. If you call us and Bob answers, you're in for a treat. Get 100% US-based customer service and talk to a real person day or night. Discover. Exceptionally common sense.
The stockings are hung and the shopping has begun. This holiday season, shop Cincinnati favorite gift cards at Kroger. Grab a gift card to La Rosa's and enjoy a warm slice of pizza. Or snag a gift card to Grater's and treat yourself to something sweet. Whoever you're shopping for, you'll earn 4 times fuel points on Cincinnati favorite gift cards. Head over to giftcards.kroger.com/Cincinnati-favorites to complete your shopping list and support our local businesses. Available in Cincinnati, Columbus, and Louisville markets only. Restrictions apply. See website for details.
Thank you for listening to TSX Quarterly. If you enjoyed the cast, remember to leave a good rating. And remember, for any additional inquiries, please consult the company's investor relations section on their website. See you next time.